Here you see Coca-Cola's financial statements, cash flow statement, operating section. And this is where we have these two methods, the direct method and the indirect method. Now keep in mind, for investing and financing cash flows is only the direct method. We tell you the cash flows, that's it. This is only a situation with operating cash flows. And operating cash flows, remember, goes at the top, then we have investing in the middle, then financing. OIF, OIF. Easy to remember. OIF. Cash flow statement, OIF. OIF. Okay, now, two ways of presenting operating cash flows. There's what's called direct. That's where we tell you the cash that came in and the cash went out. And there's indirect. That is starting with net income, showing all the adjusting items, and then winding up with cash flows from operations. Now, the FASB says that the direct method for operating cash flows is optional. I'm going to write it here. Direct is optional. Indirect is required. So what you have is one section is very different from the other two sections. Look here at, again, the statement of cash flows for Southwest Airlines. The operating section is presented using indirect, whereas investing, which is required, investing and financing are presented using direct. So the way you would really start your cash flow statement is you start with net income and you show all the items that make net income different from cash flows from operations. And then you wind up with cash flows from operations. Then you have the direct cash flows for investing activities and then the direct cash flows for financing activities. And all this comes together at the bottom. The way this ends up is you add together the operating, investing, and financing, OIF, OIF, and you get a net change in cash. You add it to the beginning balance, and then you get the ending balance. So in this case, operating plus investing plus financing is a decrease of $432 million. We had cash in the beginning of the year of $1,261,000, and so we have cash at the end of the year of $829 million, that is. This is the structure of the statement of cash flows. Two other points I want to make before we get into direct and indirect in more detail. At the bottom of the cash flow, you have to give certain information about the company's cash flow. So companies are required to present interest paid and income taxes paid. Those are two numbers that are required to be presented. They're usually presented at the bottom of the cash flows. Free cash flow does not have to be presented. It just happens to be in this case. The other thing that I want to explain to you is that we do not do the statement of cash flows for cash only. In the real world, anyone here work in a bank? In the real world, companies don't use a lot of cash because cash and a cash bank balance provides a very low yield, a very low rate of return, usually zero interest nowadays. So what companies usually do is they do not have large cash balances. Like I can guarantee you that Southwest Airlines did not have $829 million in its bank account on December 31st of 2011 or 12, whatever that is. Rather, what companies do is they invest in very highly liquid investments, very short-term investments that give them some kind of return. One example is a money market fund. Another example are government treasury bills. These are highly secure investments. They're highly liquid, meaning that you can sell them like that. So if the company needs cash, it can immediately sell these investments and get cash. But they provide you with some rate of return. If you had $829 million, would you put it in a passbook account where you earn zero return? Absolutely not. You would put it in a money market account where you earn a small return, maybe 2 or 3%. And that's what companies do. So what we do when we say cash, we mean not only cash in a standard bank account, but we also mean investments in highly liquid securities like money market accounts and also government treasury bills. And these provide a small return, which is a good thing. So now this is the format that you would typically see for a statement of cash flows. Operating section can be presented two ways. Again, what a company is going to do here is it has to present indirect. But if it wants to, it can also present the direct method as an optional method. And Coca-Cola is one of the companies that happens to do both methods, just in case, well, you're probably not interested. And let's just contrast them again to make sure you understand. And when I go through these topics, believe me, I go through them because I wanted that by the time you walk out of class, you pretty much understand everything that's going on. And then when you're studying for this is just review. And you don't have to go home and first figure all this stuff out for the first time. So if I'm very repetitive, especially I find myself doing that a lot today, if I'm very repetitive, I'm sorry. But, you know, this is how we do financial accounting with so little homework. We have then the direct method, cash received from customers, cash paid to suppliers. That's direct cash flows, just like we've been doing all along. Remember, cash received from customers is sort of like sales. Cash paid to suppliers is sort of like cost of goods sold. Cash paid for operating expenses, that's sort of like operating expenses, but it's a cash paid. It's not recorded when expenses are recorded. It's recorded when we pay the cash. Cash from operations, $4.459 billion. Now let's look at the indirect method. Remember again, the indirect method compares net income to cash flows from operating activities. So this particular company has net income of $37.51, and then it had depreciation expense. There it is, added to it for $863 million. So because depreciation expense is not a cash expense that the company has to pay for, it adds it to net income. Because that would explain why we have more cash flow. Because a big expense we didn't have to pay for. So therefore, then there's a couple of other items here. I'm just going to again talk about accounts receivable, inventory, and accounts payable. There is an increase in accounts payable, meaning we had sales that we didn't collect. So it's subtracted. We had an increase in inventory. That means we paid for inventory that we didn't sell. Increase in inventory. We paid for inventory that we didn't sell. What would happen to your cash flow? That would really hurt your cash flow. I have a cash flow story for you. It's a personal story. I hope you don't mind. My dad ran a business. My grandfather started a paint store in the 1920s. Literally the 1920s. It's pretty incredible. An auto paint store in Queens. My grandfather started it, and my father inherited it in the 1970s. And my father built up the business from there, and he sold auto paints for many, many years. But he always had a problem because there wasn't enough room in the store. He never had enough room in the store to stock all of his merchandise. So finally, he decided to expand, and he bought a new building and moved into the building. And within a year, he closed. So what happened was he got the new building, and he's like, wow, now I can stock all the merchandise my customers want. So he ordered all this new merchandise, took on a new product line, and filled up the new building. And then he couldn't pay for it. There just wasn't enough cash flow. Sales didn't increase at the same pace as his inventory. So all of a sudden, he had these huge bills for all his inventory purchase, and he just didn't have the cash flow to pay for it. So what happened was he took out a loan, then he didn't have the sales to protect the loan. It was a really painful, it's not something I would wish on my worst enemy. But the idea is basically there, is that if you accumulate too much inventory or too much assets, that hurts your cash flow. Another thing is you have here an increase in receivables. If you don't collect your receivables fast enough, then you're not going to have the cash flow. So what you constantly have to do is you make a sale, collect the money, make a sale, collect the money, and so on. And that's what's going to make you give you good liquidity so that you have the cash flow to support your business. Now here's another one, increase in accounts payable. They're paying their bills more slowly. What does that mean? Better cash flow, more cash flow. You pay your bills more slowly, you're going to have better cash flow. Now they have a decrease in accrued expenses. This means that they paid for more expenses more quickly and therefore a decrease in cash flow. So what's the end of the story? The end of the story is, well, my mom is a big saver, so my dad, she all along, my dad's like, my dad like went to my mom at one point. She's like, give us some cash flow to bail out the business. My mom's like, no way. I've been saving all this money for retirement. We're not touching that money. So my dad wound up retiring, and they live quite nicely in Florida now. Thank you very much. But that's what happens if you accumulate too much assets, and you don't have the cash flow to support those assets. You're in big trouble, and that's why productivity is so important. The only way he would have made it if he tripled his warehouse space, and he doubled his overhead. So if you're going to triple your warehouse space, double your overhead, and more than double the amount of inventory, then what do you have to do with sales? You have to double your sales, right? If you're not going to double your sales, which he didn't do, then that's going to be the beginning of the end. Okay, so interesting story. Anyway, this explains why Coca-Cola, they had $3,751,000,000 in income, but they had $4,459,000,000 in cash flow. And you might say that's not a big difference. But again, look at the numbers. That is a $700 million difference. And I don't know about you, to me, that's a lot of money. So, let's answer some questions and then we're going to be done. The indirect format of the operating section starts with net income. Statement A above reports net cash from operating activities using which method? The direct method, where statement B uses the indirect method. The direct and indirect methods report the same amount or different amounts for net cash from operating activities. It's the same amount. They should give you the same answer. If they don't, there's a mistake. These two numbers here, whichever method you use, you should still get to the same answer. However, which method conveys information already reported elsewhere? This you're probably not going to get, the indirect method. Because all this information, you know depreciation expense from the income statement, and you know the changes in these current assets and current liabilities. These you're going to know from the balance sheet. So you have all this information already. Whereas the direct method reveals new information not found elsewhere. It's not 100% true, but okay. So no additional information is shared. When you have the direct method, no additional information is shared with anybody. Therefore, most companies prefer the indirect method. They just don't want to, they're concerned that providing this information it'll be too much information, that it might scare, it might give away information to competitors and things like that. I don't know if that's really true. Statement B, let's look at that. No net cash from operating activities is greater than or less than net income. It's greater than net income. The difference is primarily due to what? The adjustment, is it for depreciation expense or changes in accounts receivable? Yeah, depreciation expense here is huge. Because most companies report depreciation expense, most companies also report net cash from operating activities as greater than net income. It's almost always the case. If you see a company where cash flows from operations is less than net income, then look at it very, very carefully to understand why. It's a huge trigger. It's a huge indicator that there's something wrong. Because you have earning, look, you want profitability that's good. Can it be profit? Is some profits better than other profits? Think about it for a second. Some profit better than other profit? let's think about a business for a second. All right, let's do Coca-Cola. How would you want Coca-Cola ideally to make its profits? Selling its products. What would you consider profit that's poor quality?
Selling their PPE.
Yeah, selling PP&E at a gain. Because you know what? You can only do it once. You got a factory and you sell it. All right, now what are you going to do for your next act? Whereas if the company is consistently selling its products at a profit, and that profit and sales are increasing, that's really good because that tells you that the company is going to continue to be profitable. By the way, is anyone here doing Coca-Cola? Does anyone know, is that the case with Coca-Cola? It's not. People are not buying soft drinks anymore. They're not. Soft drink sales are either increasing at a decreasing rate or they're actually going down. Sales of sugary soft drinks, I think, are actually starting to drop. So the company, and think about it, like what is Coca-Cola doing to get people to buy more soft drinks? Besides those cool little capsules you're going to be able to buy. Yeah.
Isn't that thing in New York where they got, where they banned like that 32 ounce?
Yeah. So what if you're Coca-Cola, what would you do about that?
Charge less for the 16 ounces?
There's a major political movement against your product. They're making Coca-Cola out to be as bad as cigarettes, right? They're like starting to ban large drinks, large sugary drinks. And there's a movement against it because people are saying that sugary drinks lead to obesity, right? Now you could say, well, then drink diet, but diet drinks cause cancer. So, you know, should I be fat or dead? What am I supposed to do? I can't win.
How does diet cause cancer?
I don't know. These phenylalanins are known. Yeah, phenylketonurics and phenylalanine. Yeah, that it's all supposed to be. They're saying that they may be cancerous. Also, caramel coloring is being banned in some states because they're saying that it's associated with cancer. So you can't win at all, and you can't drink a cola without caramel coloring. You guys are too young to remember Pepsi Clear. It was very bad. It was really Crystal Pepsi. That's what it's called, Crystal Pepsi.
Isn't that what they call Sprite now?
Right, but it wasn't a cola. It was Sprite. Sprite should be clear. Cola should be brown. Right? What if you drank? You guys never had Crystal Pepsi, right? So imagine drinking a clear cold drink and then tasting Pepsi. It doesn't work. But my point is this: if you're looking for high quality earnings, you're going to look for earnings from selling products that is the main company's business that are going to increase. Now, you may have situations where sales income is higher than cash flow, meaning that you're making sales but you're not collecting the money from those sales. Does that bother you? Because it would bother me. To me, good sales come with cash flow. And if a company has good income, but the cash flow is somehow lacking, then I would want to understand why. There may be a good reason, but then again, there may not be a good reason. So is it possible to report a net loss and still positive net cash inflow from operations? Yes, it is. So now I'm going to digress for 10 minutes, and then I'm just going to let you go. And then I think next time we'll do activity 49.